The last 12 to 18 months in markets has certainly been extraordinary. We saw a significant sell-off in markets with the start of the coronavirus back in March of 2020. What was unusual about it was the duration of the sell-off. Most bear markets last for close to a year or 300 odd days. This one lasted only 33 days. Subsequently, we've seen extraordinarily strong rebound in markets, predominantly supported by what the governments, so from a fiscal policy perspective, and also central banks globally have done to remove uncertainty from the market. We are now, however, back above all-time highs in most equity markets. We spoke about the once-in-a-decade opportunity from a valuation perspective late last year. We're actually seeing some of that opportunity start to play out right now. We're coming into the second phase of the recovery process, the first phase being where you actually get an expansion of the PE multiple. So in other words, price is rising faster than earnings. In this next phase, earnings is going to have to do some more of the heavy lifting. We're certainly seeing excesses in some of the segments of the market. And you'll remember last year the dominance of the top 5 tech stocks, or the FANGs as they were called, and just the dominance that they actually had in the performance of the market. What we've seen since about October of last year is a rotation starting to occur out of some of these areas of the market that are quite expensive and quite lofty valuations, and they're rotating into more of the cyclical valuation opportunities that we've been speaking about. So we've been well placed to take advantage of those particular opportunities. From here though, because markets are expensive and earnings is going to be particularly important in terms of future returns, it's important that we approach the market with a degree of caution. Energy has been one of the key focuses of our portfolio since the crisis started to play out. At the beginning, there was a little bit of a stumble from OPEC Plus with regards to inventories, but they managed to keep inventories low. And what we're seeing now is inventories are starting to be drawn down. So the oil market has all but self-corrected from what was a historically large demand shock to oil. And we actually have oil prices now above mid-cycle price level, where mid-cycle we're assuming is about $55 a barrel. So that's played out in different ways. So the European energy exposures that we've had in the portfolio are up on average around 60%, whereas the US exposures are now over 100% from when we initiated the positions. Now, the reason why the US has actually done better than Europe is that the US energy companies are more exposed to upstream production. So in other words, extracting the oil, the production cycle, whereas the European are more actually exposed to the downstream. So in other words, the area of the oil industry that is closer to the consumer. So they're more leveraged to the economy's reopening back up. So with regards to our exposure to energy, we still see significant upside from here. So there still is a significant cyclical tailwind associated with these positions. However, from here, once again, a lot of that valuation has played out, and it is all going to be about earnings coming through and also dividends being repaid out, with a lot of these businesses cutting dividends back in 2020. From our perspective, we have started to rotate the portfolio predominantly out of the US names that have largely played out and more heavily focused on European energy, partly because of that exposure to downstream and their leverage to the reopening of the economy, but also because they're a lot further along in their development from a renewables perspective. So at this point in time, the renewables investment that these European energy companies are actually making is almost a free option from a stock price perspective. So the UK is up 43% in local currency terms since its March lows. In a general context, when you're looking at what is available from equity markets, UK still offers really good value, particularly if you're taking an unhedged exposure, which we have, because the pound is actually quite cheap at this point in time. Once again, going forward, because we have had some reversion of the price, going forward, it is all about earnings and dividends that are coming through some of these positions. So we have been rotating the portfolio to ensure that we're in the sectors that are going to benefit from earnings and dividends coming back online. So that includes predominantly energy, financials, and telcos within that space. Given the performance of markets and the fact that most equity markets are back at all-time highs, we've been mindful of actually taking profits and locking in the returns that we've made for you and for your clients. we're starting to pull back the growth exposures of the portfolios, being mindful of where we're at from an economic perspective and a valuation perspective within the markets. As I mentioned, we have been rotating within some of our favoured exposures. So for example, within energy, we're starting to largely rotate out of the US energy market and into the European market, where we find that there is more upside. We're also looking at areas like European telcos, where we think they're going to offer better valuation on a go-forward basis.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.